The following program was produced by an independent community producer. The opinions expressed do not necessarily reflect those of the ECAT staff or board of directors.
Welcome to Well Informed. Well Informed is an affiliate of the Retirement Education Center of North America. The Retirement Education Center of North America is intended to be an educational awareness organization. We do not advise, market, or refer services. The content and discussion presented in this program are for broad informational purposes only and are not to be replaced, used, or misconstrued as professional advice. Please consult your advisor for information pertaining to your personal individual situation. My name's Mark Cardoza. I'm your host. Today's episode is one of three-part series: estate planning, tax planning for retirement, and income planning for retirement. Today's topic is tax planning for retirement. My guests are estate planning and elder law attorney Lawrence S. Zaharoff, college professor, attorney, and CPA Timothy A. Gagnon, founder and senior managing director of Heritage Wealth Management, Vincent Serratore. Welcome, gentlemen. Let's begin. First, to get started, we just want to go over some fundamental terms for the viewers, because oftentimes when we meet with people, they get confused with what qualified money is and what non-qualified money is. So let's set the stage and let's define qualified money. Vincent, what's qualified money?
Well, I think the easiest way, because it can get somewhat confusing, just all qualified money would be money earmarked for retirement that is set aside in a retirement plan that is for future use.
Okay.
Whether it be an IRA, a 401k, 403b, a 457 plan, or any other retirement vehicle to be used for the future.
Excellent. Tim, non-qualified.
It's all that other money you have, and all money is good money.
So if it's not qualified, it's non-qualified.
It's the difference of how it gets taxed. Qualified money is all subject to taxation when it comes out of the plan. Non-qualified, you're only going to be paying the cap gains or the interest and dividends. You're not going to pay in the principal. Comes out. Think of it that way. So what am I paying taxes on? What part of the money I got in do I have to pay taxes on? Your wages are non-qualified, but you have to pay on them because you never paid tax on them before. If you invest in the stock market, the principal you put in, you're not going to pay on again. You paid it on the first time. But any interest, dividends, cap gains you are. If it was coming out of the 401k though, it's 100% taxable because you've never paid taxes on it.
Tax on it. So is it simple to say, as Vincent mentioned, qualified money is money that you've put into a retirement program like a 401k, 403b, SEP, those vehicles.
A deferral type program.
A deferral type program. Non-qualified money is money that you spend every day for your groceries, pay your bills, put in your investment portfolio, after-tax portfolio. Is that a simplified?
It's workable.
Okay. So prior to April 15th, when you're preparing your income tax, you turn on TV and they say, stuff more into your 401k as much as you can. Why?
But that had to be done before December 31.
Okay. So what are they talking about?
They're talking about maximizing your contributions to your 401k so that you lower your income taxes for the current year. But you've put that money in a situation where you can't get to it quickly. It's going to be deferred, but if you take it out and you're under the age, you're going to pay a 10% penalty plus taxes on it.
Okay.
So it's money you're going to look at for going long term, but it will cut your current income taxes. That's why we also tell people to do their IRA contribution, because you can cut your income taxes down.
I'm going to lower my tax rate that particular year.
Not the rate, you're going to really lower what you're going to owe.
Okay, correct. What I'm going to pay in taxes that particular year.
Assuming that you're eligible based on whatever retirement plan you have at work. If you are eligible for another retirement plan, obviously your tax plan or CPA would advise you if there were other retirement vehicles that you could use. But a lot of times if you have a 401k, it's hard to also contribute to another retirement plan as well.
Okay. So what
Except if you have a side business, you can do a SEP.
Yes, yes. So obviously, consult with your CPA or tax advisor on what options you have after December 31st.
So a SEP is a self-employed pension, which is just putting money into the account, and when you retire, you get an income stream out of it, like a pension. Okay, so that's one of the tools they would use. Okay, so are there any particular calculations we use to determining how much money a person should put into a retirement fund, a qualified program?
You want me to
Go
address
for it.
that first? So obviously that is very subjective to the financial situations of individuals and families. If you are able to contribute, one of the things, especially in the workplace, is if your employer is matching your retirement plan, we recommend to try to contribute as much up to the match. Because in essence, if you were to put in $500, your employer would match that same $500. But again, it's subjective to whatever your financial situation and what you're able to or not do to fund the plans.
The IRS code gives you caps, maximums, doesn't give you minimums.
So the IRS code gives you caps. So you can go up to
25,000 into your 401k, and maybe there's a makeup because you're over 50, and that will give you another 5, 6.
Okay.
And the IRA's got a cap on it. So the code says if you want to take the deduction, there's a cap to how much you can put in, but anything below that, it's fine. They're not going to look at it. So when we start to see percentages is usually when we start to look at self-employed people, because they can put up to 25% of their total income, but only up to $66,000 in 2023. So, you know, that cap is a percentage, but it's also a dollar, hard dollar. But anything below that counts.
So after tax season's done, oftentimes my accountant will tell me we need to set something up in the fall to discuss next year.
Yeah.
Why?
Two things. One is, can we get more into, and are you fully funding your retirement? So we're reducing there. Second part is, when we have an idea what your income is, are you putting sufficient tax money in order to avoid underpayment penalties? Because if you don't make certain limits as to how much you have in, the IRS will charge you underpayment penalties plus interest, which can run 11, 12, 13%, which is pretty hard. Sorry, Vincent, but it's very hard to make that on the little bits of money we're talking about. So the whole thing is to properly plan. The other thing is, quite often when we get to that point, we start to say, okay, what are your deductions? Is there a way to up your deductions? Maybe it's charity. Maybe we get some more non-cash charity in. How can we bump it so that we can reduce taxes? You have to plan during the year. You can't plan after the year because it's too late to do anything. So usually for most accountants, October, November, December are heavy planning. We're done doing returns to turn in, but now we're planning for the current year. And most clients can't tell me January, February what their income's going to be. They have no idea. Because what about bonuses, how much interest, what the cap gains are? I mean, all that comes into play because it's all taxed on a certain area. But I have to know what kind of income it is to know what tax is on it. So I have to be able to try to project in how much we need to do.
So that October, November meeting is important.
Oh, yes.
For many people. Even if it's a mirror of the previous year, it's always good to visit, take that.
Everybody always tells me it's a mirror just like last year. And then when we start asking, deductions are different because your home mortgage went down, your real estate taxes went up. There's no year that's ever perfectly like last year. There's always little quirks.
Yeah, and the IRS rules and regulations change from year to year.
Day to day.
Day to day. Okay.
And I always find that last quarter meeting to be crucial as well, because you have an investment professional and you don't know what they're doing in regards to, are we tax harvesting your portfolio so we can take advantage of gains and losses in the portfolio? And obviously with us not knowing what's happening on the tax side, it's difficult for us to do our job. So we find that it's imperative that the CPA, tax preparer, and the investment professional also coordinate, because that way we're utilizing all the tax benefits between the money that's being managed and what the tax situation is, which most times we're not aware of.
That makes sense. So going to this meeting with the advisors is important.
We're always screaming at the financial advisor, what cap gain's been all year.
Mhm.
'Cause
And,
nobody tells
and we'll
me in
speak of the
advance.
CPAs for not telling us. So, you know,
Yeah.
it works
It's
both
like-
ways.
And the problem is the client is sitting in the middle, saying, I didn't know I should have asked for this, and I didn't know I needed this information.
But that's why it's usually very important that the team that you have in place, you give them permission to talk to each other.
Mhm.
I mean, do you need to sit in the middle of it, or can Vince and I call each other and say, hey, where are gains and what's that going to affect? And, you know, what are you harvesting? We can have that whole discussion, and the client doesn't have to sit in the middle. We just have to tell them what happened and what we're doing, but that way they're not caught in the middle. And I'm sorry to say, I don't usually like the client talking to me than going to talk to the advisor, because it doesn't seem like the same things get said. What did they hear and what did they say? As opposed to, if I go talk to the advisor, I know precisely what I said, and they do too.
Well, it's a different language,
It's like playing charades
Right.
if they go in between me.
right? I remember taking accounting in college, and as soon as I learned the language of accounting, I understood what was going on. And that's important for the two of you and sometimes the attorney to understand all that, because they could be selling a home, and if the home was sold in the course of a year, that changes their whole
Oh, yeah.
the whole landscape.
What's the exclusion? Are they
Mhm.
over? What's their basis?
So as far as tax deferred interest, Vincent, if we go year after year after year, maxing out our 401k, our 403b, what type of expectation should a person have after the end of 20, 30 years when they start looking at retirement?
Well, I think from an investing standpoint, obviously the first thing that needs to come into consideration is the risk tolerance of the individuals. You know, what their comfort level is and how much risk we take or don't take. Some clients will be very conservative. They're very comfortable being in CDs, keeping their money in the bank, know that it's safe and it's insured. Then you have others that like to invest in the next new technology, you know, fast flying stock that comes out there. So the goal is for the investment professional and the clients to figure out what is appropriate. And it takes some time. It's not a quick 5 minutes, we determine what your risk tolerance is, but it's imperative that they find what it is. And obviously our job is to, you know, educate them as well on risk and time, because we feel that you need to keep your assets invested in the stock market in order to grow substantially over a 20, 30-year time frame. But understanding how it all works is important. And obviously we don't expect them to know everything, but you know, they don't need to know how the watch works, but at least know how to tell what time it is. So
But
it works
tolerance also
together.
changes over time, so it's not a one shot. It's going to change as you change jobs, career,
Mhm.
family life,
Right.
age. So you've got to have a constant interaction with your financial advisor to keep looking at where the tolerance is, because it's not a snapshot and you're done.
That life gets in the way of 30 years, and a lot of things happen in that 30 years. So it's a constant review and constant change.
Yeah, and there are
and that's
positive and
important.
negatives to that.
Mhm. And looking at the past of the stock market, we have great times, we've had bad times. So it's important to always be in communication with your investment professional on a regular basis to make sure that you're all, you know, comfortable and aware of where we are today and where we're trying to go in the future.
It must drive you crazy. You must get haunted all the time.
No, I think once people are, you know, understanding of what they're trying to do, I think it becomes an easier process. And when there's constant review and communication, I think it's a lot easier. You know, we talk about the team approach. Most clients have many professional advisors. If all those professional advisors actually speak to one another, it makes all of our jobs that much easier and benefits the client when they all speak to one another.
Well, that's what it's all about.
Right.
Yeah. So, Tim, we've accumulated all this qualified asset retirement funds for over 20, 30 years. How's it affecting my income tax in 20, 30 years?
You've acquired that tax liability over 20, 30 years,
Mm-hmm.
because when it comes out, we're paying taxes on certain accounts. I mean, excluding the Roth and like that, but on the typical 401k or IRA, as it comes out, we're paying taxes on what comes out.
Mhm.
But also keep in mind, whatever the balance of that retirement account is when you die, it's included in your estate. So that 20, 30 years where you suddenly got a huge retirement account that you haven't yet paid the income taxes on, your beneficiary is going to pay the income taxes. And it's going to be included in your estate, so you may be paying estate tax. And if you ever take out money out of it to pay the estate tax, you're talking at about an 80 cent per dollar tax, because you're going to pay the income tax and the estate tax. So I mean, it's a pending liability that you need to manage.
Right. So if I take out $200,000 out of my qualified fund, my tax rate is going to go up as well.
Yeah.
So I'll end up paying more in taxes.
Because taking it out of the 401k, even though if they sold stock to give it to you, that doesn't give you cap gain rates, it's still ordinary income.
Ordinary. Okay. Larry, can I protect that in a trust?
No, because the IRS requires you to own your own retirement account. It's only when you pass away could you have named while you were alive the next beneficiary to be a trust.
So it remains in my name under my Social Security number.
Correct.
And therefore, in order to free up that money to put it into a trust, what do I need to do?
No, not free up to put into a trust. You pass away and you have $1 million left in your 401k. While you were alive, there was a retirement plan trust, and you've designated that when you pass away, the asset is going into that retirement plan trust.
But if I want to free up the money in your retirement plan while you're alive, I got to take it out and pay taxes on it.
Pay taxes.
Correct.
Like, to clean it up, I got to pay the taxes. Because
So,
even the retirement trust, when it comes out of there, it's got an income tax.
It will always have income tax.
You never avoid the
don't go
tax. Right.
never avoid tax. So it's sort of like kicking the can down the road. I know you guys use that term a lot. We're kicking the can down the road.
Yeah.
So what we're not paying in taxes today, we're paying in taxes 10, 15, 20 years from now.
Or someone else.
Or a
someone else.
beneficiary who might have been, or a group of beneficiaries who individually might be in a lower tax bracket.
Okay.
Just may put them in a higher one.
So how do we balance off qualified savings? How do we balance that off? And so that when we do retire, because honestly, if I'm putting in, and we see people all the time that they've put 80% of their money in a qualified position because either their employer or they saw it on TV suggested put more money because so now they sit there and they go, I've got 80% in my qualified fund. What can I do before in that 10, 20, 30 years to offset that qualified asset?
So obviously we're assuming after they retired.
No, before they're retired, while they're accumulating. Then we'll get to after they're retired.
Well, if while they're still working and they're contributing to a 401k or whatever the retirement vehicle of choice that the company offers, it's difficult to do other things unless the company has in their plan description options for outsourcing funds to a different retirement plan. So a lot of it is predicated on the plan that you have at your employer. But while you're still working and contributing, majority of the time the investments are held at an institution under the employer's name.
Okay, so
And
what
once you leave work, then obviously they become portable, where you have the ability to transfer them. For instance, we're talking 401k plan. You can take an old 401k plan and contribute to your new employer's 401k plan, or you'd have an option to roll it over into another retirement plan, like an IRA or a Roth IRA, which would have some tax implications, but there are some choices when you leave your place of work, what you'd like to do with that plan.
Okay, so let's look. I met with a young man last week, 26 years old, and his employer has come out with an employer-sponsored Roth. So he's paying the taxes up front, and he's putting it into an employer-sponsored Roth. Tell me about tell me about employer-sponsored Roths.
Well, first of all, I think it's fantastic. I mean, it's growing in popularity. The Roths, more and more companies are starting to add it as a feature. The fact that I have the ability to put money in, get a match from my employer, pay the taxes today, but then have 30 years of tax-free or tax-deferred growth and tax-free withdrawals gives so much more purchasing power to that individual over his lifetime. So whenever we can, we like to pay the taxes on retirement funds today and have tax-free benefits for the future. Because today, we know what the tax implications are on our retirement benefits. In the future, we don't. So the more assets that we can grow on a tax-free basis, we tend to recommend that for clients.
In 2019,
But make sure you can pay the tax on the Roth money out of what you have left, because you can't take it out of the Roth.
Right.
So you got to make sure you can fund the tax even though you didn't get the money.
Right. Correct. Okay. Fund a lot. Make sure you have the money to pay your taxes.
Because of Roth, you're not going to get a deduction for it. It's not going to reduce your income.
Right.
You're going to pay the taxes on that money even though you didn't get it.
Okay. But the benefit of doing that is down the road.
Absolute benefit. It's just we run into clients at times that they've gone so heavy into that, it cut their check down so far, and now to pay the taxes, they're in trouble. They didn't leave enough behind to pay.
Yeah. So it's a balancing act. Like I mentioned,
totally.
how do we balance this off? We're kicking the can down the road, and then one time we're not kicking the can down the road, but we're putting into a Roth, so we're paying a little more taxes that year. And so it has to be a balancing act. And that's probably why sitting down in November, talking to your advisor or your tax people, and determining how much should be in a Roth and should not be in a Roth, and balancing that out. I think that's kind of an important place to be.
And we tell them to sit down in January and project out just to see where you're going to be. I mean, always better to make decisions with information than without it.
So in 2019, the Secure Act was signed into law. And in that Secure Act, there's a bunch of things, but one of the things we're going to talk about today is income. They focused on creating income for people because they understood that pensions weren't as popular anymore. Pensions were there for municipal employees or union workers. And other than that, you don't see a lot of private pensions in companies anymore. They've all gone to contributing, matching money into their 401k, 403bs. So the Secure Act came out, and then recently they changed the Secure Act. The Secure Act 2.0 came out and discussed a Roth, moving money from a 529 into a Roth if it's not used for education. Any comments on that?
Well, the 529, we're getting off from the retirement plans and now focusing on college savings. So families are beginning to look at ways to fund for college education down the road. 529 obviously is a great vehicle to use, but one of the big issues is, what if, little Sammy doesn't go to college? Or what if he goes to vocational school? What happens to those funds? In the past, before 2.0 came out, what would have happened was those funds would have been a 10% penalty, and then income taxes would have had to been paid. What now has happened is that you can now roll that money, and by rolling is transferring it from 529 into a Roth for the beneficiary up to $35,000. So there is now an exit strategy without taxes and penalties if the funds are not used. So they're just trying to make it easier for families to help pay for the cost of ever rising tuition.
So who benefits from that? If I have a 529 and I don't need it to pay for my children's education, I'm able to put it into a Roth. Is it going to my name or is it going to their name?
It shows the name of the beneficiary.
So it would be their name.
Yes.
And it's
Keep in mind,
529 is also,
529 the name of the beneficiary.
name of the beneficiary,
Not yours.
so it wouldn't even be a gift.
No.
Perfect. Okay. One of the things we want to talk about is tax-free income and why that's important. So we worked on this chart, and I just want to address it. So this is a married couple filing jointly. They have a Social Security, a pension, they have qualified funds, they have investment interest, they have tax-free income, and they have a total income. Then they have the taxable. And I want to point out that this went through the what if worksheet for CPAs in 2022. So these numbers, even though they're fictional, they actually work in the sense that in the IRS laws of 2022.
Federal only. Yep.
Federal only. So in example A, the person put all their assets in a qualified fund, $37,000. And they had an interest of $15,000 that was taxable. And they had a pension of $20,000 that was taxable. And the Social Security, because their taxable income was $130,000, the Social Security was 85% taxable. So in this example, the taxable income was $121,000, and they ended up paying income tax of $10,553. In example B, they had no qualified funds. They pulled all their money from a tax-free income, whether it be a Roth, and another tax-free vehicle is a permanent life insurance policy that's designed to create tax-free income
Or municipal securities.
or municipal securities. So they took the $37,000 there. They still had the same net income, total income. Their taxable income then was $58,000. So now their taxable income was $2,800. Their tax they had to pay was $2,839. So in Schedule C, same situation, but we split it up, qualified and tax-free, 50-50. Same total income. Taxable income was $992,225, and the total income tax was $69,43. So it boils down to a difference of $3,500 in column C, which could be used for vacationing, whatever they want to do, adding carpet to their home, whatever. So let's talk to me about this.
But this is why I mentioned earlier, it's not just total income, it's what type of income is it. And that'll make the determination of taxability, non-taxability, and what you end up with. You have to look at what kind it is. I mean, even if you took this scenario a little bit further and you were getting cap gains, they're taxed at a different rate than ordinary income. So quality of the money and what it's from can make a difference of what tax you owe.
Mm-hmm.
All right, so it's always factoring that in. The more you can get out you don't pay on is always nice, because that means there's a smaller check to write. Because, I mean, if you look at that first one, it's a check for 10 grand. Look at the one next to it, a check for 2 grand. I don't know about you, but 8 grand less out of my checking account goes a lot further to things I like to do. Because that's the way it is. But taxes, you cannot take them in isolation. You've got to look at what's creating them, the income, where's it come from, what's the tax rate is it at, and what will be in that effect.
Okay, and this obviously is, this couple has retired. So let's put this in a different perspective. The couple has retired. They believed in putting a lot of money into qualified assets and maybe some into a tax-free situation. And they come to a point where they're concerned with their taxes. They're retiring. They're concerned with their taxes, but also they might have some medical issues. And as Larry said, you can't protect this money, medical issues. So let's set an example. They're 60 years old. Let's go 65 years old. They come in and they need to, and they're retiring next month. What do we do to help them reduce that qualified asset so that we can protect some of that money so we have to pay taxes on? So what do we do?
Sometimes we do a cleanup procedure in that we look at what bracket they're in and how much more could I take into that bracket. So I take that out of my qualified, clean it up, pay the taxes on, so now I can go invest it anywhere. I can give it to my financial advisor and say, grow this like crazy, make up for it. But I do it over time so that I get an orderly distribution and slowly clean the money up than doing it all at once.
So if I'm 65 years old, I anticipate I might have a medical issue, but I know I can, without any crazy things, I know I might live the next 10, 15, 20 years. So I then schedule my money, my retirement funds out to pay a consistent tax over those years so that at the end result, I can pay less, I'll have less vulnerable tax when I die, less vulnerable.
Keep in mind also, if you've got heavy medical, which is a deduction, I may be able to take more out of the qualified fund in order to offset the medical deduction. So therefore, I may be able to get more out and not pay a lot of tax on it. Mm-hmm. Again, you've got to look at the whole scenario and know what's going on, which is why that third quarter meeting is important, because where are we? How much have you had? What are we at to? What could we get out? And not up the tax bill.
And Larry, how does that handle the legal perspective?
The only issue for me is when you mention health, we may have a Medicaid issue down the road. And that's something we should be looking at. Typically, we would take, Tim, without saying it, talked about the marginal and the effective tax rate. We have to look at that and maybe start funding a Medicaid trust. We're pulling money out of the qualified funds and putting it into an irrevocable trust to begin the 5-year look-back period to protect those assets. Because if you go into a nursing home, because of your health, you now have to spend down in order to all of your assets in order to qualify for
Including your
Mass
qualified
Health,
funds.
including your qualified funds. And the qualified funds haven't been taxed at the income tax level. So I have people walk in and say, well, we have $1 million in our retirement account. And they assume, well, nursing home is $100,000 a year. They have 10 years worth of payments. And I have to point out to them that when they pull out $100,000, they could pay as much as 35% in income taxes. So instead of having 10 years of private pay at a nursing home, they may only have 7 years at a nursing home.
So if I were in my 50s and healthy, and I opened up a long-term care insurance policy, how will that affect the outcome when I go to retire and look at distributing my qualified assets?
But you're buying me time that you're not going to go to the nursing home and have to use them. So long-term care policy is going to cover time there. So you're helping me with the 5-year look back. So the second you go in, I dump all the money out, pay the taxes, and give it away. So that now I've cleaned it up, but I've got to be able to pay for that 5 years, the long-term care, covering what I'm in order to clean that up.
So long-term care plays a role, long-term care insurance potentially plays a role,
A major role.
a major role.
Let's
A
call it
major
a
role.
tool in the whole overall plan.
Yes.
It's not the be-all, end-all, but it's a tool to help the plan work. And I have to say, don't try this on your own. This is very sophisticated and complicated, and working it through. I mean, you can't do it on the back sheet of a paper or the envelope.
Well, I know a lot of times I'll get a phone call and I'm asked to meet with a client to look at a long-term care program for them before the attorney will design an estate plan. And based on my findings with the long-term care, determines how that estate plan is set up. Larry, can you take it from there?
Tim mentioned that the long-term care policy will pay for the first year, 2 years, 3 years of the 5-year look-back period. So it gives us more options on how to preserve and protect your assets and even the other assets to continue to grow once you've put them into a Medicaid trust, other vehicles that are available for the client.
This is where timing becomes critical.
Yeah.
Communication, this reverts back to what we said originally. You have a life-changing event. To me, every 3 to 5 years, you come in, you tell me what's going on, I tell you what laws have changed. You can tell me that you purchased a long-term care insurance policy or you have one from work. Well, now we can start planning for the next 10, 15, 20 years until your retirement. And should something happen, we've got that plan to protect as much of the assets as possible while keeping your quality of life intact.
Excellent.
And keep in mind, from Mass Health standpoint, husband and wife are one. They're not two different people. So whatever the spouse has with you when you go to Mass Health, it's all included. So just moving it between husband and wife doesn't do you any good because they look at you as a one number. So it is moving it out to Medicaid trust or moving it out to the kids or you've got to get it out of dominion and control of both spouses or it's not off the table. And all that's part of the overall planning that Larry's trying to get done in order to move things around, but you got to get it out to qualify as out for Mass Health. And they are very, could we say, particular and very fact specific, and it's not something, I say it again, it's not something you can do on your own on a Saturday or Sunday. It's a lot of knowledge, and the way they keep changing the rules, it's a lot of knowing where the rules changed.
How does that fit your world, Vincent?
Well,
Obviously there's a lot of different strategies that you can use. Anytime we have a client that goes to a nursing home, we're utilizing their current income. We're looking at also the investment portfolio, what we have for dividends, gains, what we can use in cooperation with whatever legal documents are created. So we work hand in hand with attorney and CPA of how we're going to liquidate funds, how do we do it tax efficient, and how do we protect the assets at the same time. So as Tim had said, you don't do it on the back of a napkin, but at the same time too, there are multiple strategies, and based on the assets that you have and the time that we're trying to fit into paying for it, as well as what you're trying to accomplish, all fit into different strategies.
Very
So
good.
it works, but it's just what's appropriate for that client.
I've gone to the financial advisor before and said, you need to generate X more dollars per year so we get through our 5 years so we can get the assets out of there.
Mhm.
But I got to know what the numbers you're working with and what I've got to offset.
Excellent. Well, thank you, gentlemen. I think this has been an enlightening session. Larry, any last comments?
It is very important to continue to communicate with your advisors, always on an ongoing basis. Don't wait 5 years to call up your investment advisor, your accountant, your lawyer, and say, hey, 3 years ago, I had a life-changing event. Now I see the impact. What should I do now? Well, the barn door has been closed and the horses are out. We have some tools that we can still use, but don't shut the door on us with all the tools that we may be able to use. Communicate with us.
Thank you. Vincent?
I couldn't agree any more with Larry with that in regards that you have to communicate. You are responsible for your own money and your investments, your taxes, your legal, for your family. So it's important that you stay active and diligent on being aware of what you have and is it set up properly.
Tim?
It's easier to plan to the future than it is to fix something in the past. Not terrible, I know, but it's easier for us to look at something and plan going down, knowing what's going to happen, than it is to try to fix it after the fact, because then it's too late. And yes, you have tools, but they're not as good a tools as you could have had 3 years ago.
Words of wisdom. One thing I want to point out as a closing comment of my own, Positioning for Retirement has chapter 16 is where it all comes together, which is kind of interesting. This page layout was actually it's a little dear to me. My late brother-in-law, Jay Sari, we were walking out of a building. He was reviewing this with me. He stopped and he said, I have the perfect layout for this. We could do 1, 2, 3. But what this is telling you in this chapter 16, and you're welcome to get the book. It's at the Ames Free Library, or we can give copies out for a $20 donation to ECAT, and also a $10 PDF copy to your email and donation to ECAT. But again, you can find it at the Ames Free Library. It's on the local author shelf. But this page here is important because it shows you the impact of just a little bit of non-qualified money in your portfolio. And in the third scenario, the person or couple, their income is on the larger side, is $329,000. But over 20 years, they saved close to $600,000 in taxes just by repositioning a little bit of their assets. This other one here is they're at an $80,000 income bracket, and they end up saving about $4,000 a year in taxes over that 20-year period. So that is, I think, a substantial thing. So that's pointed out in this book, and a lot of what we discussed here is part of this book. So anyway, with that, I want to close. I'd like to thank, gentlemen, I'd like to thank you, and I'd like to extend my gratitude to ECAT for allowing us to share this content with their viewers. We hope you found the episode helpful and look forward to the other topics. ECAT thrives on sponsorships and one-time or monthly donations. Please donate to ECAT. Thank you for joining us today, and please stay safe and well informed. Welcome to Well Informed Behind the Scene. We just had a great episode with Tim, Larry, and Vincent on tax planning for retirement. So I just want to go a little deeper into that. And behind the scene is about just giving you a little different perspective and giving you, pointing out some things that I think are important and kind of simplifying things. So the episode was tax planning for retirement. But tax planning for retirement is all about your retirement funds. Pretty much. They're the portion of your portfolio that is going to get taxed when you retire. All right, so that's kind of the touchy part. Other parts of your portfolio are considered non-qualified, and the only taxation on those are going to be the growth, or capital gains, or interest growth. So that's going to happen regardless. But what we can control is the taxation on our retirement funds. And a lot of times it takes place well in advance of retiring. And I know we've all been taught to put as much in our retirement plan as possible so that when we retire, we have a healthy portfolio. But, and it's great every year we're able to put more in up to the limit, and our taxes, we pay less in taxes. You know, if you have children, you have a mortgage to pay, it's great to have the extra cash flow and not have to pay Uncle Sam. But evidently you got to pay the piper, right? So this is what happens. What we're finding out is when people retire, they've done well collecting assets. They may have had two incomes. They may have had strong incomes, whatever it is, but they've built this pile of money in a qualified or retirement plan, 401k, 403b. And then they go to retire and they've got their Social Security, they may have a pension, and then they've got their 401ks they've got to start drawing off of with required minimum distributions. And at that point they go, oh my God, I'm getting taxed more during retirement than I was getting taxed in the accumulation phase. So it sounds kind of crazy. And a lot of times when we look at a person's assets and portfolios, we'll tell them you're in that category where you're going to get, and they don't quite understand that because they always thought that when I retire, I'll pay less in tax. Well, that's not true for everyone. It's true for some, but not everyone. So what needs to take place is way before you retire, like in your 40s or your 30s, you start looking at where you're going and start navigating the waters so that when you do retire, then you know what you're going to be taxed on. You have an idea where you're going and how you're going to get there. In closing, I just want to leave you with a few points, and they're tools for you, and it's important for you guys to have. We have a book called Positioning for Retirement, which we've talked about. It's on the local author shelf at the Ames Street Library. You can get it through ECAT for a $10 donation, and we'll also send it to you as a PDF to your email for a $10, $20 for the book. But there's other things we have as well. We talked about the app that's coming out soon. As soon as you get it, we'll have it ready for you, and you can find it on Google Play and at the Apple Store. And also, there's a long-term care investment impact study, which is on our website at RERCNA.com. You can pull it right up. It's on the front page. There's an icon, and it's 83 pages long. You're welcome to read it. You can print it out. And if you have any other questions, feel free to reach out to us. We're there for you. We want to help people. That's our objective. Build teams and help people get to where they need to go. And thank you. Have a safe and happy day. We're different. Our focus is on estate and elder insurance planning. Our mission is to protect your estate from being spent down for long-term care. You may never need care, but it's good to be prepared. Know your options and create a plan. We work hard to protect what you worked hard to build.